Everyone, welcome back. And we're going to start talking about stock. When companies issue stock, how does that look? Are there different types of stock? Do they ever maybe have an interest in buying their own stock back? Those are all the questions that we are going to answer. So over here, we see that there are different types of stock, okay? And different types, yes, by terms of maybe different classes, but different types by hey, how much is in the public's hands? So what happens is a company's going to go through the process, right? In their probably articles of incorporation, when they go through the process of becoming a corporation, and they're going to say, hey, how much do I have authorized? Just the total amount that I can have shareholders buy, right? So it's the total numbers of shares available to sell. So you have to think about this as just the total, the overall pie. Okay, that's authorized. Issued shares are the number of shares that have been sold to investors. So a company typically doesn't issue all authorized stock. Okay, so they've issued it, and if you have issued it, it has gone in the hands, right, of an investor. So you've sold it, it's been issued. Now, what you're going to say is, now how much is still in investors' hands? It's currently held, right? So it is currently held by investors. Now, why would you have issued but not outstanding stock? Well, because I've gone through the process of buying some of it back. So it's been issued, but now I, Apple, have gone back and repurchased it. Okay, so it's in my hands. It's been issued, but it's in my hands as the company. Okay, so you can think about it in terms of this little like pie, or you can think about it in terms of just definitionally. Okay, authorized, total amount stated in my articles of incorporation. Issued, it's been sold, investors have touched it. Outstanding, how much is still in investors' hand, because I know that I might have bought some back and I, the company, right, am holding this share as treasury stock. We're going to talk more about that. So don't worry too much about the treasury piece yet. Okay. So then also with stock, you're going to have something called a par value. And the par value is exactly this. It's the legal capital per share of stock that's assigned when the corporation is first established. So par value is, I mean, it's kind of a silly concept, if I'm being completely honest with you, because it has no bearing on really much at all. Okay. So par value originally indicated the real value of a company's share per stock, but today par value has no relationship to the market value of stock. So a lot of the times companies will have like a $1 par value, or they'll have a 1 cent par value, but they might be trading at, $100, $200 per share. So this is going to be the best example of this is going to be like Facebook. Their common stock has a par value of $0.00006 per share. That's ridiculous, right? Because Facebook's been trading at well over $100 for the last decade. Okay. So it doesn't really have that much bearing, right, on much other than how we account for it. Now, the last thing that I will say too is you can have a no par stock. And a no par stock, well, that just means you didn't assign a value to it when you first issued it. So laws in many states allow companies to do this, okay? And a lot of new companies, right, choose to have no par common stock. So a company like Nike, a company like Procter & Gamble, like they just don't have stock associated with it. So kind of interesting. I would say par value is somewhat outdated. But again, it does impact how we account for things. So how does it impact it? Well, we're going to say for the rest of this chapter that we are Canadian Falcon, and we issue 1,000 shares of 1 cent par value common stock at $30 a share. So again, we have to ask ourselves fundamentally, what is happening? Okay. What's happening? I am issuing stock, and a customer, right, or a shareholder, I should say, is giving me cash. So is cash changing hands? Yeah, absolutely. My cash is going up. How much cash is the shareholder giving me? Well, they're giving me $30, the market value, multiplied by the 1,000 shares that they're purchasing. So they're giving me 30,000 bucks. Okay. What's the other side of this transaction? Am I establishing a liability? Am I giving them an asset? No. Think about where we're at over here. We're in this equity piece. So I am going to somehow need to impact my common stock account. Okay. How much am I going to impact my common stock account by? Well, this is where this gets silly. I hit it at par value multiplied by my number of shares. So I will have common stock of 30, right, being impacted. Sorry, that should be, how do I get my little eraser? If I could do math, that would probably be helpful. Huh? So common stock, that should be 10, sorry. So then you're like, well, what the heck, my journal entry doesn't balance. We are going to hit APIC, okay? So APIC is going to be a plug figure to get this journal entry to balance. So this, I'm going to write plug. And what is this? It's called additional paid-in capital. So I will always just write either PIC or APIC here, okay? So if you look at this, this is a very silly looking journal entry, but this is how we account for things. I will hit my common stock account at par value. That's always going to be the case, right? I hit my cash for market value because that's what a company or a shareholder, is actually giving me, and I will plug the rest into APIC. All right. So now we see the difference where it looks like in a second scenario, right? The same company issues 1,000 shares, but they don't have a par value associated with it. So again, fundamentally ask yourself, what is going on here? Well, somebody is still giving me cash, right? And they're going out into the marketplace and spending $30 a share and buying 1,000 shares. So I'm getting $30,000 of cash as the company. Do I have a par value? Well, no, I don't. So what that means is I just throw it all into common stock because I don't have a par value associated with it. So if I had a par value, I would do it like this. But since I don't have a par value, I just throw it all into common stock, and that's totally fine. Okay. So company A issues 20,000 shares of $5 par value common stock at $12.50 a share. The entry to record the issuance would include which? Well, I would say just do the full journal entry. Okay. So again, fundamentally, when a company issues shares, what's going on? They're getting cash. What are they getting cash for? The market value. So I have 20,000 shares multiplied by the market value of 12. And let me write market up here. So they are giving me cash of how much? 250,000. What am I giving them? Well, I'm giving them part ownership in my company. So my common stock account is going up. How much is my common stock account going up by? Well, here I hit common stock with par. So I have 100,000 bucks that I'm throwing into my common stock account. So now my debits don't equal my credits. What do I plug with? Additional paid-in capital. So I have my plug or my fill figure of APIC. So now I just need to find, well, no, I don't debit cash for 100 grand. I definitely don't throw it all into common stock because it has a par value associated with it. Oh, yep, I credit my paid-in capital by 150. Okay. So here, what we've been talking about is called common stock, right? So common stock is just the most general form of stock. It really doesn't have anything fancy associated with it. Okay. So common stockholders are the true owners of a business, right? So now you have this thing called preferred stock, and preferred stock is preferred, quote unquote, over common stock in two main ways. So usually they have the first rights to the specified amount of dividends. Okay. So a company declares dividends, preferred stock, they're going to get that first. Okay. And then they also are going to receive preference over common shareholders in the distribution of assets. So a company goes bankrupt, you're going to pay your preferred shareholders first. Okay. So how do you account for it? It's going to be pretty similar, actually. All right. So assume Canadian Falcon issues 1,000 shares of $30 par value preferred stock for $40 a share. Again, root yourself in cash. Am I the corporation getting cash? Well, yeah, absolutely. I'm getting cash, and that's equal to what? Well, it's the market value of 40 multiplied by my number of shares. So this shareholder is giving me $40,000 in cash. What am I giving them? I'm giving them part ownership in my company. My stock's going up. What kind of stock is going up? Preferred stock. Notice it's a little bit different, right? I house it in a different account because it's a fundamentally different type of stock. What do I hit my preferred stock with? Well, I always hit my stock account with my par value if I have one. So I have 30,000 sitting in preferred stock. Now, what do you think I'm going to plug the rest to? Well, I'm not that creative. I'm just going to throw it into APIC. Okay. So I have APIC of 10,000 going up, which is my issuing preferred stock above par. Okay. So I've increased an asset, increased equity, increased a different equity account, right? My accounting equation is still in balance. So how does my balance sheet look? Well, it looks kind of silly, right? Because I have my preferred stock account that's actually sitting there at my 30. I just made that journal entry. Now I have common stock sitting there at just 10, right? Well, then the majority of my paid in capital really is sitting in my APIC account. And again, that's just because we account for stock with par value. So I have total paid in capital of 70. Now it's telling me I have retained earnings, right? That's earned capital. We haven't quite talked about that yet. That's totally fine. We'll talk about it later. But then I have total stockholders' equity of $100,000. So why would a company issue preferred stock, or what are some of the features of preferred stock? Because we know that they have preference in dividends and preference in dissolution of assets. Okay. But preferred stock is interesting because it's kind of flexible in its contractual provisions. Okay. So you could have certain features of preferred stock that just make it somewhat flexible. So it's interesting, okay, because a lot of the times preferred stock is referred to as a hybrid between debt and equity. What do I mean by it's a hybrid between debt and equity? Well, it kind of has features of both debt or a liability and that equity account. Okay, so it's convertible. So that means, or it can be convertible, right? Which allows the shareholders to exchange shares of preferred stock for common stock at a specified conversion ratio. So maybe you trade in 2 preferred stock, I give you 1 common. Occasionally, preferred stock is redeemable at the option of either the shareholder or the corporation. It could be either. So a redemption privilege might allow preferred stockholders the option, under specified conditions, to return their shares for a predetermined redemption price. Okay. So what that means is, hey, I'm going to buy back all of your preferred stock, and I'm going to buy it back at $100. I set that $100 price, at the onset. Okay. So I'm going to go ahead and buy it back. I'm going to redeem it. Preferred stock is going to, I'm going to write this, it's usually cumulative. So just like we've said, right, they have a preference to dividends. Well, typically you're going to have a cumulative preferred stock. So what that means is if a company does not declare dividends in a given year, they become dividends in arrears. Okay, so you have some dividends in arrears, and that means that they accumulate until the company does declare dividends. Okay, so hey, I can't afford to pay dividends this year. Well, that's totally okay, but you owe those preferred shareholders dividends the next time you declare them. Okay, so you kind of got to keep track of that. We'll look at an example of that coming up shortly. But when you're looking at different financing alternatives, right, you have equity, you have liabilities, and then preferred stock is an equity, but it's kind of more of that hybrid account, right? And why is it hybrid? Because voting rights, okay? Liabilities, your bonds, they don't have it. Common stock usually does. Preferred stock normally doesn't. Like, we normally don't really give preferred stockholders the right to vote. Now, common stock, well, yeah, you have risk to the investor and there's expected return to the investor. Yeah, it's the highest amount, right? Because I'm solely investing in you, hoping your stock price goes up. Well, your stock price could go down. Really, it's I'm taking a gamble, right? And the higher the risk of your company is, the more return I'm going to demand, right? But with bonds, I have specified repayment dates. I have interest associated with it. Yeah, you have default risk with some bonds, but most of the time they're significantly less risky than just an equity security like a common stock. Okay. Common stock. Well, now all of a sudden we're over here and we're like, you don't really get much preference for dividends or dissolution of assets. Bonds, you do, right? Because again, this is a liability you're contractually obligated to owe them, right? So I got to satisfy every obligation before I can give it to any of my equity shareholders. And then over here, right? Well, dividends, you can't deduct dividends on your tax return, but you can deduct interest from a bond perspective. And then notice those preferred shareholders, well, they're just kind of hanging out in the middle because you're like, it's more risky than a bond, but less risky than just common stock because, right, I have preference in these things. So again, just kind of different, right? They act as a hybrid security, but we do classify it as equity in our balance sheet. So then the last kind of security to talk about, or not security per se, but it's going to be accounting for treasury stock. So when we were thinking about treasury stock, right, we had our authorized, we had our issued, then we had our outstanding and our treasury stock. And again, we said that this was all of our issued. So treasury stock, this is just what we call a company's own issued stock that has been purchased. So why do you think a company is going to buy back their own stock? To boost underpriced stock, right? You're like, hey, I think the market price is too low. So in order to support the price, I'm just going to decrease the supply of stock in the marketplace, right? I'm going to go buy it back. And then my earnings per share, right? My EPS, well, that's going to go up because earnings per share is just in its simplest form, net income divided by outstanding shares. Well, I've just decreased my denominator. My overall EPS is going to be driven up. Okay. So I'm going to boost my underpriced stock. I'm going to boost my EPS. These two kind of work in tandem. The other reason that a company might do that is to distribute surplus cash without paying dividends. So dividends are usually a good thing, right? But investors do pay income tax on them. So another way for a firm to distribute surplus cash to shareholders without giving them a taxable dividend is to use the excess cash to purchase its own stock. Right. And then the last thing, super quick, is to satisfy employee stock ownership plans. So sometimes a company will redistribute some of its treasury stock to employees for compensation. You'll learn a lot more about this in accounting 2120. Yeah. Intermediate 2. So how do you account for treasury stock? Well, if you think about it, just super quick, seriously, think about what treasury stock is telling me. Okay, I'm buying my own stock back. So what do you think that means? That means I am reducing my shareholders' equity. I had this in the marketplace and now I don't, right? I'm reducing my shareholders' equity. So how we do this, right, is through a contra equity account. So you should be able to say treasury stock reduces shareholders' equity by way of a contra equity account, which has a normal debit balance. You should be able to walk through that process, kind of root it back to the accounting equation to understand fundamentally what's going on. So I think the best way to do this is through an example. Okay, where it says Canadian Falcon repurchases 100,000 of its own 1 cent par value common stock at $30 a share. Okay, so again, root yourself in cash. Is a corporation getting cash? No, they're paying cash. They are paying cash at the market value. They're paying those investors. They're saying, I'm going to give you $30 and I'm going to buy back 100 shares. So I have $3,000 that I'm reducing my shares by. Okay, so now I don't come hit my common stock account. I house it in a treasury stock account. And this, again, is a contra equity account. So it has a normal debit balance. And I do not care about par value when dealing with treasury stock. Par value does not matter. So I'm just going to hit my treasury stock by the same amount. So I like to go ahead and hold this amount of 30 multiplied by 100. I like to have that associated with my treasury stock because this is going to come back to play if we ever reissue these shares. So again, treasury stock, contra equity, reduces shareholders' equity, normal debit balance. I always hit it at the market price. Okay. Par value doesn't matter with treasury stock. So look at our partial balance sheet now and what we have going on. Well, before, this is what we had calculated, but now I have this $3,000 contra equity account. I've reduced my shareholders' equity by $3,000. That should make sense because this is a contra equity account. Okay. So now I'm going to resell some of my treasury stock because think about some of the reasons that we were housing it. We were like, hey, I want to boost EPS. I want to boost my underpriced stock. Maybe I'm going to give it to some of my employees. Okay, so you resell it when that time comes. So Canadian Falcon resells the 100 shares of treasury stock for $35. And notice it says, recall that these shares originally were purchased for $30 a share. So the biggest thing that I'm going to always tell you to do is just root yourself in cash. How much cash is this company getting? Okay, well, they're getting $30 per share. Or sorry, they're getting $25 or $35 per share. So some shareholder is giving them $35, the market price, in order to get part ownership of their company. That's great. I'm getting $3,500. Now here's where it gets funny, and this is why I said I always like to keep this 30 right here, is because when I come and get rid of my treasury stock, and that's exactly what I do, I just reverse this out. I get rid of my treasury stock, my number of shares that I'm selling, multiplied by what I originally put it on my books for. Okay. So this was the original purchase price of my treasury stock. So I reduced my treasury stock by 3,000. And now I'm going to plug or just throw the rest into my additional paid in capital for 500. Think about why you don't hit treasury stock at the total amount of the 35. Well, think about what we did over here in this journal entry. I established treasury stock at 3,000. So I only have 3,000 to remove, right? I can only reduce this balance to zero. I can't make a contra equity account go positive, right? That's not how that works. So I reduce it to zero and throw the rest in my additional paid in capital. Okay. So now, oh, well, check out what we've done. I have not, this was before where we saw that reduction of the 3,000. So I had 97,000 sitting in my shareholders' equity. I haven't issued any additional shares, right? I reissued treasury stock. Notice the difference. Okay. So what are the things that have changed? The first thing I'm going to do is I'm going to look down here at my treasury stock. Again, think about this journal or this T account. Yeah, my treasury stock should be zero, right? But when I reissued my treasury stock, well, remember, I hit my additional paid in capital by an additional $500. So I now see this increase by the $500 that I hit my APIC with. Okay. So the other thing is, right, and just think about kind of conceptually what could happen. Well, yeah, great. I sold my treasury stock for more than I bought it for. What if I don't? Like, what if I made a bad call? What if my stock price continues to go down? Right. So now assume that, and this is kind of like an independent example, right? Assume that Canadian Falcon resells the 100 shares of treasury stock, but it's below cost. So I was only able to get $25 rather than 35. Now, remember, it was still originally purchased for 30, and that's important to me regardless. So how much cash is a shareholder giving me for this treasury stock? They're giving me $25 times my 100 shares. So I'm getting $2,500. Okay. How much am I getting treasury stock off my books for? Oh, it's still the original purchase price. Still that OG. That's still important to me for all 100 shares. So I have 3,000 that I'm decreasing my treasury stock by. And just super quick before we finish this journal entry, think about it. I hit it by 3,000. I'm reducing it by 3,000. So I have no more flexibility in my treasury stock. I've resold everything that I own. But now my debits don't equal my credits, and this is going to look silly, but I need to hit my APIC account over here to get it to balance. So notice APIC, she's going to be flexible, okay? Because this is just my plug figure, and I need to get this to balance. So here I'm reducing my equity account or my total equity, right, by way of reducing my additional paid-in capital. That's totally an acceptable thing to do, okay? So treasury stock summary over here, we include treasury stock in the shareholders' equity section of the balance sheet as a reduction to shareholders' equity. So an increase in treasury stock decreases shareholders' equity. Why do we do that? Because it's a contra equity account. My contra equity has a normal debit balance. You have to be able to know that. And you have to be able to see that, okay? So when we resell my treasury stock, the amount of the sales price above or below is reported as an increase or a decrease in APIC, right? That's when we always plug it, because I am going to reduce, right, my treasury stock account at the original price. So my OG price, that is what I am always going to be hitting my treasury stock account with, okay? So that really sums up any of my invested capital or my paid-in capital. So join me next time where we will talk about earned capital, aka retained earnings. So I will see you there.